Good evening. My name is David Terwill, and I'm chairman of our investment committee at Private Wealth Asset Management. I'd like to welcome you and thank you for joining our inaugural Capital Markets Update Call. Tonight, you are going to hear from several of our founding partners and senior members of our investment committee as we traverse the dynamic and ever-changing economic landscape with a focus on how our clients can be and should be prepared to navigate the financial markets with confidence. Speaking tonight, you will hear from Tim Neen from Denver, Colorado, David Holtorf from Omaha, Nebraska, Brett Halley from Des Moines, Iowa, Deborah Wilkins from San Antonio, Texas, and Chris Casey from Cedar Rapids, Iowa. It has truly been my distinct privilege to work alongside these partners and the rest of our investment committee, which collectively bring over 200 years of combined experience to help our clients manage their financial assets. I really think you will enjoy the insights that they bring to us tonight. We've had several questions asked in advance via email, but I'd also like to encourage you to ask questions via the chat feature tonight, and we'll be addressing those throughout the presentation. With that, let's jump right in. Tim Neen, I'm going to come to you first to talk about what we're hearing around the street.
Thanks, David. Well, first of all, let me just give a quick shout out to Kim, our very talented Director of Philanthropic Services. Well, all of us in the investment space and portfolio managers have been busy staying on top of the markets and keeping our portfolios right. Kim put all this together, so thank you again. Let me get started here and tell you one of the great things about the world of independence is that we truly get to hear research from everywhere on the street. Instead of just one place, we can now literally listen to the best minds from everywhere. And tonight, I'm going to tell you what people from Morgan Stanley are saying. I'm going to tell you what people at The Economist are saying, people at JP Morgan, Barron's, Morningstar, Wells Fargo, Goldman Sachs, Merrill Lynch, all these different places, and try to give you a taste of what some of the best minds on the street are thinking, and so that you can take these ideas back and talk with your own investment specialists about these ideas. So let's get started looking around the street. So first one is, let's start with Morgan Stanley. Morgan Stanley continues to be the most bearish of all the firms that we follow. Mike Wilson, who's head of strategy at Morgan Stanley, calls their strategy fire and ice. And what he's referring to as fires, he means they're projecting that there'll be a much higher rates. They're projecting that there'll be a less accommodative Fed, which means the Fed's going to stop buying bonds and supporting, and the Fed will raise rates instead of keeping rates low. And the other part of the fire is they think that multiple compression will happen. We're trading at some sectors are at all-time highs right now, and all of them are close to all-time highs. And they're projecting that these will return to more normalized multiples. So that's the fire part of their feelings about the market. The ice part of it's a little bit different. The ice part is a look at what they believe is a decline in consumer spending. And they believe that unlike most of the firms that we follow, that it won't accelerate back up in Q4 as COVID continues to get better and people go back to work and so on. And they're really the major player out on the street that's thinking that things will get worse before they get better. Perhaps the most interesting comment that I've read from Morgan Stanley over the last month or two has been their feelings about green hydrogen. And if those of you don't know what green hydrogen is, feel free to talk to your investment specialist about it, but probably the cleanest way for us to build lots of transportation. But the new tax plan has an incredible $3 per kilogram tax credit in it. And Morgan Stanley is projecting that this is actually going to make it all the way through. Now, whether Morgan Stanley's right or not is another issue, but nonetheless, it's a real interesting idea if they are. Turning away from Morgan Stanley, we'll talk about The Economist a little bit, kind of in the funny and factual column here. The Economist wrote a week or so ago a briefing about, well, it was this week actually, yeah, a briefing about how the world is so focused on clean energy. And yet at the end of last week, Exxon and Chevron, of course, both posted massive quarters, making $3 billion and $2 billion respectively more than they made the quarter before. So non-clean energy is still making money, that's for sure. One of our all-time favorites is David Kelly at JP Morgan. Dr. Kelly has been somebody we followed for decades, and Dr. Kelly put out a piece on why stagflation is not going to happen. And it has always been one of our fears that we've kept looking for here, because the last time stagflation hit the markets, it was an extraordinarily ugly period. But his whole rationale behind this is stagflation can't happen when you have low unemployment. And we tend to agree with that opinion. The other things that Dr. Kelly's been writing about is the importance of diversification and valuation. He talks a lot about how far the market's absorbed here, and that these rather simple ideas in investment methodology, diversification and valuation, these are almost like forgotten because the bull market's been so long. But actually, we need to stay focused on these things because they're going to become increasingly important as the market becomes more difficult. The other thing that Dr. Kelly said interesting is a strong disagreement to Morgan Stanley. He thinks that the slowdown in consumer spending will actually end in the fourth quarter. And he talks about how the supply chain issues are getting better, COVID is getting better, and he thinks it's probably going to come back in a roar towards the end of the fourth quarter. Perhaps the most interesting thing to come out of JP Morgan in the last couple of months has been their feeling that the big differentiator here is the wage gains. And they reminded us not to forget that people are now making dramatically more money per hour than they were making before in the lower and middle income areas. And I'm sure many of you that own businesses have seen that. And the bottom line is JP Morgan is extraordinarily bullish because they believe that those higher wages will outweigh the higher taxes and the decline in government spending eventually. And note that that'll even get stronger as we move into 2022. Our friends at Barron's put out a great report last Friday talking about probably the most overlooked piece of the new tax legislation being the tax on corporate buybacks. So most of you know that a lot of the big companies that we own are actively engaged in corporate buybacks, and that supports their stock price, and more importantly, puts everybody, well aligned. If this were to go into effect, and we don't know that it will, of course, but if it were, what Barron's was questioning is whether this would become a drag on corporations continuing to buy back their stock. And they made a strong notation that we certainly took note of, that of just how big stock buyback plans have been over the last several years and how important they are to many of these stocks' pricing. Our friends at Morningstar obviously fill our mailboxes with great research every day, but they had a really interesting piece that came out on the new taxation of ETFs. In the new proposed law, and again, no one's saying that any of this is going to get passed, but the taxation on ETFs would change, and they would be treated much more like mutual funds. And for those of you who don't know, ETFs have traditionally experienced less taxable income, less capital gains, mainly because they take money in and give money out often in kind, meaning they simply just sell stocks less than mutual funds do, creating less capital gains. So obviously, if ETFs were to be taxed a different way, that would be a negative towards using them. I think or at least what Morningstar's viewpoint is the passage of this proposal has a low probability, but nonetheless worth something keeping an eye on. Another note from Morningstar is they have a major, they see a major change going on in our own industry, in the asset management industry. There's, for the first time ever, seeing the big brokerages, big banks starting to combine asset managers, meaning that instead of, bank A just offering every product under their name, right? Large cap, small cap, international, fill in the bank's name. They're starting to say, well, we'll use our large cap and we'll use, somebody else's fixed income and so on. And what Morningstar is writing about is that everyone's finally recognizing that no one company is the best investor at everything, and that research really is the heart of all this at the end of the day, and finding out not who the biggest investment managers are, but who the best asset managers are. And that's great news to us, because we've been kind of saying that for a long time, that that's the key to finding the best talent out there. David Sikra, who's leads research at Morningstar, put out a very bullish statement. He is now saying that Morningstar has more 4- and 5-star rated stocks than they have in over a decade and a half. All right, that's quite a statement, and it just backs up why Morningstar as a firm remains very, very bullish. He claims the most overvalued areas are healthcare and real estate, and he claims the most undervalued, interestingly enough, is energy. And if he had to pick one sector, his favorite sector is small and mid-value as the most undervalued area. Our friend Chris Harvey from Wells Fargo sends us a lot of stuff as well, and we always call Chris the Ultra Bull because he just seems to always be bullish. But Chris is betting on a very vibrant year-end rally, quote unquote. That's what he calls it. But he really thinks that this is kind of the last run in the market, if you will, and that 2022 is going to be a difficult year. And I think his exact words is, we are very, very late in the bull market. And so he thinks the end of the year is going to be very strong, but next year is going to be very weak. Our friends over at Goldman Sachs think that core inflation is going to be the big driver next year. They are the only firm that we're following that is projecting a major decline in core inflation. They're projecting a decline from 4.3 down all the way down to 2.25. And it's interesting. They think that labor shortages are going to get much better, which is the real driver here. Obviously, if there's more workers, you don't need to pay workers as much money to get them to go to work, right? So, but they think those labor shortages are going to get much better as COVID gets better, and most importantly, in their view, as government subsidies in. Probably the most interesting thing that came out of Goldman Sachs was a long white paper about China. What they were referring to is the $8.2 trillion in local government financing vehicles. They're called LGFVs. And according to Goldman, this is the scariest thing that's going on in the world right now from an economic standpoint, that China is pumping so much money into these local government financing vehicles, which are really just a way to give what we would call a state in the US money to hand out to people or developers who are going to develop a new airport or something like that. But basically Goldman's claim is that these things are not well thought out, that what they're building is not producing enough money to pay back the money that China has given them, and that if these things blow up, it'll make the last round we had in 08-07 looked like a minor thing for China, not for us, but for China. Their conclusion was they think that 52%, believe it or not, 52% of China's GDP is due to these type of vehicles. So that's obviously a massive amount. So we're watching that in China. Obviously, if China had another difficult time period, it'd be a hard time for Europe as well. And that's kind of delaying our thought process about moving some more money internationally. Last but not least is our friends at Merrill Lynch. They have updated their global market view just 2 weeks ago. They're calling now for higher interest rates. It's interesting, and rising inflation. So just exactly the opposite of Goldman Sachs. And they believe that those higher interest rates and the rising inflation is going to lead to some cyclicality in the market. And they're in massive favor right now of value stocks over growth stocks. And we tend, and by the way, they believe that's in the US market only, not in the world market, as they see risk in China as well. But that's a very, very bullish call for value stocks and that tilt that we've been talking about for some time. So, David, that's a look around the street and what other people are thinking. I hope it helped.
Thank you very much, Tim. And it absolutely helps, show kind of the global view of, how things really can differ from research firm to research firm. Now, let's really dig in and kind of see what the results were. David Holtorf is going to give us our institutional report. David, I'll turn it over to you.
Thank you, David. My time today on this call is going to be spent talking a little bit about what's happened so far this year and also where markets stand right now. So I'm going to start off talking about fixed income. So if we can have that slide on the screen. Thank you. So the chart here shows the benchmark 10-year U.S. Treasury yield starting off the year at about 93 basis points and rising throughout the year all the way up to 1.68% on October 21st. Then falling back to 1.56% at the end of last week, which is also where it ended up today as well. Going further, the spread between the 2-year and 10-year treasuries widened year over year, steepening the yield curve again through mid-October. But since then, that curve has begun to flatten again, with rates on the 2-year treasury rising over 20 basis points just in the month of October, as investors have anticipated a possibly faster than anticipated Fed Reserve plan of action on rate increases as inflationary pressures continue to remain elevated. While the chart shows the 30-year T-bond yield at 2.05% as of October 13th, it has also fallen back to 1.96%, with the spread between the 5-year and the 30-year treasuries narrowing to the smallest gap since the pandemic began. What all this data might be showing is possible concerns from investors about a slowdown in economic global growth. Lastly, on the Fed Reserve, it's widely expected this week that the Fed will officially announce the start to their tapering process, which is a reduction of the asset purchases they began in the pandemic to stimulate the economy. Fed officials really see this tapering as a precursor to the tightening of monetary policy in the form of rate hikes. So you'll see this before any rate hikes. That's something to look out for. On the international bond front, other major central banks have also started to ease their pandemic stimulus measures, with Canada ending its quantitative easing and the European Central Bank announcing that they are purchasing bonds at a, quote, moderately lower pace, end quote. Moving over to equities, the S&P 500 is up over 17.5% year to date and had risen to 4363 as of October 13th, as you can see on this chart. That trend continued in the remainder of October, with the S&P 500 having its strongest return month of the year, and with the Dow, S&P 500, and NASDAQ Composite all finishing at record highs for October. Small cap stocks represented by the Russell 2000 are up just a little over 16% year to date. These are phenomenal return numbers, especially given that 2019 and 2020's S&P 500 returns were over 31% and 18% respectively. I know it can be hard to imagine these sort of growth rates continuing indefinitely, and Brett will get into that more in his next section on today's call. Again, through 10/13/2021, international stocks as a whole, represented by the All Country World Index, excluding U.S. stocks, up 6.8% year to date. If we break that down a little bit further, international developed, represented by the Europe, Asia, and Far East Index, up 8.7%, while in internationally emerging markets, down 0.4%. Emerging markets year to date, they've been hampered and drugged down by Brazil, which is down 11.3%, and China, which is down 14.3% through that same time period. On the earnings front, earnings growth for the S&P 500 constituents has outpaced expectations in the third quarter year over year, with a large majority of companies beating their consensus earnings estimates so far in Q3 2021. At the end of the day, these earnings point to continued strong demand, which has helped companies so far overcome many macroeconomic challenges, such as supply chain issues, labor shortages, and rising input costs. That was a quick look at where we are in the markets today. I'm going to turn it back to David to Will.
Thank you, David. We're going to move to Brett and an equity outlook. And Brett, before we get started, I really just want to ask you kind of the question. We're all reading and hearing about the strength in the equity markets. We just heard David talk about that. We heard Tim talk about that. And we're hearing about the strength of the market since the bottom of the pandemic. Give us a quick recap on kind of where equity markets are today, and talk about specific areas of concerns and opportunity, that we see moving forward.
I'm happy to, David. Thanks for the intro, and good afternoon to everyone on the phone, or good evening, depending on which part of the country you are located. I thought what we'd do is take a look at a few slides from our friends at JP Morgan. I've got a few here that'll just put into a picture many of the comments that both Tim and David have already shared, kind of what's going on around the street. We have some very bullish market research. We have some very bearish market research, but if you are visually driven, let's take a look at a few slides. So this first one is just a picture of the S&P, and it does clearly show the pandemic impact, a very sharp and short drop, and then how fast and steep that recovery has been. And that's somewhat interesting. What I find more interesting on this chart, though, is the trend line that goes back to 2008 and goes up through right before the pandemic. And so you can kind of see bottom left to top right, you can see what that line looks like and just how steep we are compared to that line. So I'll talk a little bit about earnings. I'll talk a little bit about what's driving that. But you can go back through any chart you want for the history of our tradable markets, and that is an unsustainable pace of growth. That does not mean it ends tomorrow. Obviously, we can continue this trend for as long as the market feels like doing it. And in fact, anytime, and the markets are now up, David gave us a number through mid-October, the markets are up over 20%, almost 22.5% year to date, the S&P. Anytime that has happened in the first 10 months, the year does finish strong. We don't have any history that says otherwise. So that's interesting, at least as a side note. If we flip one page, though, as you think about markets, so it's, I think, important probably to define, what the S&P is. It is a market cap weighted index. So the largest companies have the most impact, and as fate would have it, we have a few gigantic companies. And so that's what this slide talks about, just how concentrated we are at the top. The top 10 stocks is really what all three of these graphs are about. The one to the left, that just shows the PE ratio of the top 10 stocks versus the other 490 stocks. And so you can see it is elevated. It's not as elevated as it was during the .com, but it's close. So it's just interesting to see that in a picture. The other two slides, though, on this page do show significant difference. The top right one, that's the weight of the top 10 stocks. And actually, if we completed that slide today, it would be at an all-time high. So we are approaching or have crossed the 30% mark. So the top 10 stocks make up 30% of that index. The bottom 490 stocks make up the other 70. And so it is very top heavy at the moment. And the bottom right chart shows that it's not all just paying a higher multiple. It is actually somewhat earnings driven. I've got another slide that'll kind of break out some earnings numbers.
Brett, this is a great spot.
Yeah.
Some of these big tech companies, just reported extremely strong earnings last week. How much farther can this go with earnings and strong big tech results?
Yeah. I had to write these numbers down just because they are shocking, just in the size. And I don't know if it's just our federal government and the budget and the deficit and those kinds of things. We're starting to get numb to words like trillions and billions and hundreds of millions. I mean, they all just kind of sound the same, but I'll use Alphabet and Microsoft as an example. So both of these companies today have a market cap of over 2 trillion. And I can remember, it was only about a year ago, we were talking about having the first $1 trillion market cap company. And here we are with a few companies that are over 2 trillion in market cap. But their earnings last week, so let's start with Alphabet, formerly known as Google, about 2.5 trillion in market cap. Had a $60 billion quarter. It was up, its earnings were up 41% year over year. And last year was good. It was up 11% sequentially. So just third quarter over second quarter, earnings up 11%. Those percentages would be great results for a $10 billion company. Very small, that would be a mid-cap stock. Those are great percentages. We're talking about a $2 trillion market cap company growing at over 40% on an earnings basis. And that is just shocking. And Microsoft, same deal, 36% year over year, 70% margins. These companies, so really, I think coming out of the pandemic, what we're seeing in this part of the space, in that tech space, in that consumer discretionary space, all the money is flowing there. What used to be a 10-year plan for a lot of these S&P companies was a 1-year plan coming out of the pandemic. And so that money is being spent, and you can clearly see where the earnings are going. So I could go down the list. Apple had a marginally disappointing result with only like 20% growth. And so its stock has actually traded off a little bit, but it's just interesting. The other thing I would note on this slide is the two charts on the right. If you look at the 2008 to 2010 time period, we had a pretty similar increase in earnings for the top 10 stocks. So the bottom right one shows the earnings spike back then, but it really did not change the market cap. If you look at the top right one, it goes up a little bit in terms of the percentage of the S&P represented by those 10 companies. So it went up a little bit, but you can see the difference in the current spike in both in earnings and what has happened. And that, again, is back to how the S&P is calculated, market cap weighted. So we've got the earnings all going to the biggest companies. We've got the S&P basically going vertical. So very, very interesting. It's an interesting time period. Obviously, the next slide puts that just in a slightly different picture from a valuation metric. It just shows how far extended we are in terms of PEs. Not surprising, given the charts we've already looked at. It does kind of put it in context going back to the .com time period. The next slide after that gets back to earnings, and it shows it in a picture. And really what we've done over the last 12 months or so is, again, if you go back to the financial crisis, we had a very similar drop back in 2008, 40% or so earnings per share growth drop. We had a 2-year recovery time period, 2009, 2010. Basically, we did that same thing, but we did it in 12 months. And so you can see the recovery of earnings. What I find interesting, though, is look at the earnings growth following that time period. So we eventually do get back to trend line earnings and, probably a little more normal growth rate. And so whether that's the Fed tapering that starts that process, whether it's some other event that we don't know of yet, we don't know where it's coming from, but at some point we will, I think, head back to more trend line kind of growth numbers. I'll kind of pause there, David, and see if there's any questions so far from the chat room.
We're good right now. Keep going, Brett.
All right. So let's jump over to maybe some opportunities or things that the committee, as we get together and bounce ideas back and forth and talk about how we're positioning client portfolios and what we think over the next 12 months, 24, 36, et cetera. Tim mentioned in the Herd on the Street roundup, we do have some shops that are starting to take note of the value versus growth component. And again, this chart goes back into the late 90s. There are time periods where growth is cheap and value is expensive. Think about the financial crisis time period. We are clearly now in a time period where value is cheap, growth is expensive. Again, it does not mean we're at an inflection point. It does not mean we go back. It just shows you kind of where we are in a picture and kind of how long the track record is in this world. But as we just talked about, the earnings are on the growth side. And so until we see earnings picking up in some of the value sectors, maybe a little more stable growth in the industrial space, financials and healthcare and energy, we can continue to see growth outperform value. There has been just a blip here, really starting about the time, almost a year ago, almost exactly a year ago, actually, when the vaccine was announced. We had, kind of a sharp reversal, and the value stock started to outperform relatively quickly. And so that was interesting to watch, although this last month of October, growth was handily ahead of value again. And so again, we're in this ebb and flow between the two sectors. So that's a little bit interesting. The one question we get from clients all the time is, how long can this go on? And that's really the purpose of the next slide. So this will put a little bit of context. It's a little bit of a busy chart, but it's very interesting. So there's green dots, and there are kind of a dark gray dot. The dark gray dots are the whole time period from the mid-60s through the financial crisis, January of 2009. The green dots are really the time period since then. And what this is showing is any dot above that line, the horizontal line that goes across there at 0, any dot above that is a time period where interest rates go up and stocks go up at the same time. And you can clearly see there's an upper left quadrant with a lot of dots and a lower right quadrant with a lot of dots. And so what the horizontal lines are showing you is that there is an inflection point in there where once interest rates get to a certain spot, if interest rates continue to go up, then stocks go down. But the point of the graph and the point of our conversations in the investment committee is we are a long way from those levels. So the time period, the most recent time period shows about a 3.5, 3.6% rate. The longer time period is more like 4.5%. And so back to David's, yeah, go ahead.
Yeah, one question that we've had in advance that's a persistent theme is as it relates to interest rates and equities. How would inflation enter this equation? We've had that several times. How would inflation kind of enter that equation where it relates to interest rates and equities?
And that gets back to the conversation the Fed is having. So, you'll note in every Fed release, they talk about inflation, they talk about their dot plot going forward. They have an expectation of future inflation, and they set interest rate policy accordingly based on their view of future inflation. Of course, when you get out of this Fed funds rate, which is the only rate they set, the market gets to decide everything else. And so the 10-year bond, the 30-year bond, the 5-year, the 2-year, that's market participation. They're also voting on what they believe future inflation will be. And so when we see it spike, that's typically an expectation that inflation is higher in the future. And that's kind of what we've seen so far this year. We have seen it fall back a little bit, but as David mentioned just a few minutes ago, we started around 90 basis points, and we're at 1.5% or so on the 10-year. So that's, the market is always voting. The Fed is trying to control the shortest end of the curve, and their primary goal is that inflation watch. And so that's a quick way to kind of figure out what impact inflation is going to have.
Perfect, Brett. Now I've got 2 more questions here from the chat, and just to remind people, if you On the bottom of your screen, there's a chat icon, and if you click that, you can submit questions. But Brett, another question we have: how do you define value? Stocks by PE. If so, what range? And also, how do you define growth? Low growth is what? High growth is what?
Yeah, so we let the major averages define what those are. And if you go back one slide, if that's possible. So the right chart on that page tells you, so it's by sector. And so it's not a pure science. There are probably growth companies that are in that top line, industrials. But in general, each sector has been coded roughly as growth or value. In reality, the S&P also defines growth and value by company. And so there's a separate index, the S&P 500 value, the S&P 500 growth. Every company falls one side or the other. There's no hard, fast definition. Each shop, whether it's Moody's or S&P or any of the major companies, can define it themselves. But that's sector-wise a pretty good indicator of where things fall. So industrials, financials, materials, energy, real estate, consumer staples, and utilities are all the value stocks. And that's, you could go into the individual names and probably find some outliers. But in general, that's a pretty good list of sectors. And then the others are obviously growth.
Thank you, Brett.
Yeah. So equity outperformance. So I'm going to spend just a little bit of time talking about, this is kind of a snapshot into our investment committee conversations. None of this is meant to say, we're going to go out and change portfolios tomorrow. We've been overweight stocks for a long time. We've been overweight U.S. stocks for a long time. But these next few charts are sort of how we start our conversation on, when do we start to look other places? When are we paying too much for future earnings of companies like Google and Microsoft? At what point, they're still, again, the earnings are amazing, but next year we're going to be looking at a 12-month year-over-year earnings, and they just set a really big bar out there. So what this chart does is show you U.S. versus foreign. It goes back to the 1970s. And so again, there's always one of them that's outperforming the other one, and you can see the ebb and the flow of what that looks like. Really going back to, really the day I chose my career, which was October of 1987, the crash. Really starting from then, the domestic has pretty much run the table. There's been a couple of time periods where international has led the way, and it was, right up until the financial crisis was one of the most recent time periods. But you can see for the last decade or more, the U.S. has outperformed foreign stocks for a very long time, and it's getting even steeper, and we're getting close to those valuation levels. If you remember back in the 80s, when Japanese companies were buying a bunch of U.S. assets, they had all the money, and you can see the really tall purple section of that chart back in the 80s. So that's international markets leading the way over and over and over again, a lot of Japanese money flooding into the U.S. If you remember that time period. So most recently, we're getting there again. So now it's U.S. dollars doing the same thing. And it's not that it ends tomorrow, but it will end. And so that's one of the things we talked about in our chart. And the next three slides kind of take a look at this same thing from different angles. This one talks about the PE ratio. And so, again, to see how cheap. So similar companies, you think about a Nestle company versus a Pepsi company. So really the same business, one's foreign, one's not. You could think about foreign energy stocks versus U.S. energy. You could think about a foreign industrial name versus a U.S. industrial name. You're paying a lot less for that same stream of earnings. It's really the same market by looking at a foreign stock. And in a lot of cases, the chart on the right, you're getting a higher dividend. Now, the trick with foreign dividends, obviously, is it's paid in a foreign currency as well. And so the trends on U.S. dollar versus that currency will either be a tailwind or a headwind, one way or the other. And if global GDP does come back post-pandemic, we would expect the rest of the world currency to sort of catch up to the dollar a little bit. You know, maybe some of that flight to quality, flight to safety that we've seen over the last 18 months softens a little bit, and you can get a tailwind on foreign dividends. And so, again, cheaper, higher dividends, lower valuations, which is the next page. As you look at global earnings growth, so the purple bars on the left, you know, show 2021 and really strong global earnings growth, but the earnings are growing faster in the emerging markets. And as David pointed out, it has not participated at the same level in terms of stock performance. It has not come through yet. And so that's interesting. And global valuations, again, you can kind of see where we are currently, US versus Japan, Europe, China, and the emerging markets. And then the last one, the last slide I have before I send it back to David is this one. And it's a little bit interesting because what it shows, the left chart, so the purple line on that chart is European luxury goods. And that's up a lot. And so there are parts of the foreign markets, and so that's very similar to what we see in the US, very similar to what we see in Asia. There's a lot of money flowing around. There are themes that are working outside the US as well, and that's one of them. The gray line at the bottom is the rest of the foreign market. And so that's the one that has not participated. So it's interesting to see that. We look at the sectors, and one of the big underperforming sectors, as you look at the bottom right chart, is the foreign financials. And so what that chart is showing you is what percent of the index was financials in 2005 versus today. And so financials are 11% smaller. We're seeing a similar thing here in the US. At one point, maybe 20 years ago, the energy sector was about 20% of the S&P 500. And as we got into this year, it was less than 2% of the S&P was in energy. Obviously, it's recovered a little bit. It's still got a long way to go to be anything that's really relevant from a sector standpoint, but you can kind of see how sectors move periodically. So big picture, you know, kind of looking at it, really strong earnings are driving really high valuations. It is sort of a high wire act. You can see that when you look around Wall Street at all the research. Some people say it keeps going. Some people say, man, it's getting really old. Maybe it's time to move to a different level. So it's interesting to see that ebb and flow. We do think, you know, taking a look at some of the opportunities on the margin, maybe pulling some money off of the US table, some of the gains we've seen this year, and finding higher dividend paying, cheaper valuations in either sector-based, you know, for example, things like energy and healthcare that maybe haven't participated, or the banks, but then also looking outside the US. So kind of on the margin, portfolios will be shifting just a little bit. We're not ready to, you know, throw in the towel on anything at the moment, but it's just interesting to kind of see everything in picture. And with that, David, I'll throw it back to you.
Thank you, Brett. Dad, we're going to dive into fixed income markets really quickly, and, you know, really kind of the same thing. You know, just give us a quick recap on kind of where we've been, and focus on areas of concern and areas of opportunity that we see moving forward.
Absolutely. Thank you, David, and thank you to everyone who took time out of their evening to join our webinar today. I'm going to talk about fixed income, and my first slide here talks about how low interest rates are. In fact, they're so low that there's a great deal of global debt trading with a negative yield. This chart shows the amount of global debt trading at a negative yield in trillions. Led by Japan and Europe, this equates to roughly 25% of the total global bond market currently. So this brings up a great question. How do yields fall below zero, and why would anyone buy debt with a negative yield? So to answer the first question, central banks lower interest rates to stimulate economic growth and encourage consumers to spend rather than to save. We experienced this from central banks globally early on during the pandemic. In the US, the Federal Reserve stepped in and set the target federal funds rate to zero. They also initiated a bond buying program with the intention of keeping rates very low. The ECB, or the European Central Bank, was the central bank to actually lower a key interest rate into negative territory, again, to incentivize spending and lending activity rather than keeping large amounts in deposits. So that brings us to the second question: why would anyone buy debt with a negative yield? For the most part, it's the large institutional investors who buy negative yielding debt. In an abundance of caution, the organizations pay over face value for high quality bonds and accept a negative return for the safety and liquidity of those instruments, namely high quality government and corporate bonds. You'll notice here on the slide that the amount of global debt with a negative yield has started to decline in recent months, there at the very end on the right of the chart. The reason for that is that we are slowly seeing interest rates begin to rise. To look at this in greater detail, the next chart shows the 10-year Treasury yield over the last 2 years. At the beginning of the pandemic, and you can see it in the low figure there in blue, in March of 2020, rates fell as low as 54 basis points or 0.54%. In contrast, you can see rates rising to 1.63 there at the end of the chart as of last week, and today they closed just lower than that at 1.56%. While this 1.63% looks very favorable relative to where we've been in this 2-year time period, it's very important to put these rates into perspective. The long-term average yield for the 10-year Treasury is 4.32%, so current rates are still extremely low historically. We believe rates are going to continue to climb as we see rising inflation and central banks backing out of stimulus measures with the economic improvement we're experiencing. So we should see that blue bar continue to rise. So I'm going to now talk about different parts of the bond market. The next slide covers the domestic investment grade market and helps to answer the question of what makes better sense for investors right now: taxable treasury bonds and corporate bonds or municipal bonds. Municipal bonds had better tax adjusted yields than their taxable counterparts earlier this year, but that has changed. Right now, maturity is incredibly important when deciding between municipal and taxable bonds. As you can see here on the chart, for 1-year bonds, municipal yields are about 0.14% and treasury yields 0.12%. So even without the tax advantage that municipal bonds receive, they're clearly the way to go with the higher yield there. For 3-year bonds, the opposite is true. With the yield differential you see there on the chart, an investor would have to pay a 60% tax rate to justify buying municipal bonds over taxable bonds. All this to say, when building the laddered bond portfolio, investors need to clearly evaluate whether taxable or municipal bonds are more advantageous for each part of the yield curve to maximize income in an environment where it's very difficult to find it. So my next 2 slides cover the high yield market. High yield bonds are issued by companies that have been rated below investment grade by credit rating agencies. Because of the lower credit rating, they have to pay a higher interest rate to compensate investors for their higher risk of default. The spread, and spread means the additional yield an investor earns on high yield bonds versus investment grade bonds, is narrowing. The chart shows that the average spread between investment grade bonds and high yield bonds is 523 basis points or 5.23%, and that's there on that blue line. And currently, with the yellow line, you can see that figure is down to 313 basis points or 3.13%. So why is that? Why is the spread narrowing so significantly from historical averages? First of all, interest rates have been low for some time now. We remember back to that Treasury chart, the last 2 years, we've seen such low rates. That's caused investors to chase yield. Demand for these higher yielding bonds has driven up prices and driven down yields. Secondly, investors have been more comfortable in this space as these below investment grade companies are showing strong performance. Default rates in the high yield space are low, and corporations are showing their ability to pay down debt, giving investors increased confidence in buying high yield debt in their portfolios. While we believe high yield bonds are an important piece of a diversified fixed income portfolio, we do want to caution investors about chasing yield. High yield bonds are still attractive with the larger income streams that they offer, again, in an environment where it's very difficult to find any substantial income. But there are risks in the asset class that should not be overlooked when you're putting together a fixed income portfolio. As in every investment decision, it's important to evaluate risk tolerance, time horizon, and liquidity needs on an individual basis when deciding how much exposure to high yield is appropriate. And again, as with any investment, we recommend dollar cost averaging into this asset class. So if higher spreads become available, an investor is not already over allocated and can still take advantage of them. So my last slide here discusses international debt. Currently, we consider international debt from other developed economies to be relatively unfavorable. If you remember from the first slide covering negative yields, a large portion of that negative yielding debt was from countries in Europe and Japan. So there's really little reason to invest in that sovereign debt when it's yielding even less than our United States investment grade bonds. Debt from the emerging markets, however, warrants consideration. This chart shows that unlike high yield bonds, emerging market spreads over regular investment grade bonds have actually widened in recent months. We had a little dip there towards the end of 2020 and early 2021, but again, the spreads have widened and they've become a little bit more attractive yield-wise recently. A big reason that this has happened is fear over regulatory action in China, as well as concern over the debt restructuring of China's second largest property developer. These concerns have led to higher yields for emerging market debt. But with that said, we expect emerging economies as a whole to experience growth in 2022. We expect growth that exceeds what the developed nations experience. Likewise, we think emerging market debt is unlikely to experience volatility due to the tapering of bond purchases like U.S. bonds. So we are positive on it as an asset class. Again, investors should be cautious about chasing income, but should absolutely consider emerging market debt as part of their diversified fixed income portfolio. So that's a brief summary on key parts of the bond market. I'd love to answer any questions. And back to you, David. Thank you.
Thank you, Deborah. Chris, we're gonna move to you and dive a little deeper into asset allocation, really pull all of this together. And so when we look at all the information that we've heard, whether it be from Tim and David, talking about what we heard around the marketplace and the results, and Brett and Deb taking a deeper look into equities and fixed income, when we put it all together with asset allocation, what calls have we made in the past, and what asset allocation changes do you see on the horizon as we look forward?
Thank you, David. And as you mentioned, we heard from Tim and David and Brett and Deborah, and thinking about those overarching themes that we see and how do we work that into our asset allocation recommendations. And really, portfolio diversification and asset allocation is at the heart of everything that we do here at Private Wealth. We definitely customize investment portfolios for each individual client. However, looking at those overarching themes and making those tilts where we see opportunity is a big part of what we do. So we do believe that clients need to be at their strategic or their long-term asset allocation the majority of the time to reach their goals. But having those tactical tilts to take advantage of some of these themes that we see in the market, there's a lot of advantages there. Building portfolios that can withstand market volatility is crucial right now. We see some market volatility on the horizon, and making sure that we build portfolios that can withstand that is important. So David, your question was a good one. What asset allocation, where have we been overweighted in the past, and do we think we'll see any changes? And Brett and Deborah talked a little bit about that. So we have been overweight domestic stocks versus international stocks year to date. We have been overweight large cap versus small cap year to date. And we have been recommending a diversified portfolio that includes a diversified fixed income portfolio, as Deborah talked about, that includes high yield bonds and international bonds. So when you look at the quilt chart that's up on your screen and you see year-to-date returns, those asset allocation calls have been good. We can see domestic stocks outperforming international stocks. We can see large cap outperforming small cap year to date, and definitely the return of high yield bonds shows some benefit of having a diversified fixed income portfolio. So those are the calls that we've had. And your question is, where do we see that changing? So this quilt chart is talking about the benefits of a diversified portfolio when we see rotations in asset classes. And Brett talked a little bit about that rotation from growth stocks to value stocks. So on the quilt chart, you can see those growth stocks are that light blue. And last year, actually, if you look at 2019 and 2020, we see growth stocks at the top of both of those years. And then value stocks are the orange block on this. And you can see year to date, we're starting to see value stocks outperform growth stocks still room there for more opportunities. So definitely some ideas and some themes that we can take advantage of when we look at this. So the fourth quarter, we're getting into the fourth quarter, and taking that opportunity to rebalance portfolios right now is I think important. So as you're visiting with your advisors, looking at opportunities to rebalance portfolios, harvest some of that excess growth that we've gotten from domestic and from large cap, and begin rebalancing portfolios and looking for opportunities. So where are those opportunities? Where are those, how do we build that theme in? So one of the things, we take a look at valuations, but we also look at where we are in the business cycle. So the next slide takes a look at the business cycle and where we are globally. So when you look at this chart, this is a normal business cycle. So we've got the early stages of a business cycle. This is when we start seeing profits begin to grow. We see inventories are low, and we start seeing sales improve, and we see really rapid growth in those early stages. And then you've got the mid stage of an economic cycle. That's where you see growth peaking. That's where you see inventories and sales growth really reaching that equilibrium and still in a good part of the market. Late stage of the cycle, that's when you start seeing growth moderating. That's when the Federal Reserve starts tightening credit. And that's when you start seeing inventories grow as sales growth falls off. And then obviously then going into a recession. So we believe that the U.S. is still in that mid-cycle. Brett talked a lot about this, that things are looking expensive, but we definitely still believe that we are in the mid part of this cycle. What that means is that growth may have peaked, that trajectory, that fast growth that Brett was talking about, that's unsustainable. But that doesn't mean that we have to have negative growth. It just means the growth is going to be slowing down. And so we're not going to repeat those double-digit returns that we've had in the growth, slowing down, but still positive growth. Not entering that late cycle yet, still a little bit early for that. We're going to continue to see the Fed begin to tighten, but maybe not this year or in the next 6 months, but eventually the Fed's going to start tightening, and then we're going to be looking for when we move into that late stage. But again, I talked about taking opportunities to rebalance, getting some of that excess return that we've gotten out of the market this year and trimming that. Where do we put that? If we sell large cap stocks, Deb talked about interest rates have gone up, but they're still relatively low. So not really interested in still keeping that. We want to keep that overweight to equities, not ready to move that excess return into the fixed income market, but there are other areas of the stock market. So when you take a look at this and see where the U.S., we're leading this economic expansion, and we see some of the international markets behind us. They have not peaked yet. So this is a nice picture that shows there's definitely some opportunities based on where we are in the economic cycle to take advantage of that. Brett talked about valuation, so that's another piece of this. So the next slide is very similar to the one that Brett showed us, but this puts everything together. So when we take a look at price to earnings ratios, Brett's right. Stocks, U.S. stocks here, they are expensive. So price to earnings ratio, what price are we paying for the earnings of those companies? You can see clearly that PE ratios here in the U.S. are above their long-term averages. So again, still like that nice overweight to U.S. domestic large cap stocks, but if we're rebalancing, where are we going to take and move those profits? You can see here that international markets are historically below those PE ratios. So again, opportunity to do some rebalancing in our portfolios. Talked a little bit about inflation, and I do want to spend some time on that. So when we look at asset allocation and trying to build in some inflation protection into our portfolios. So what asset allocation calls can we make here? So the market's near-term inflation expectations remain higher than their pre-pandemic levels. We are likely to see inflation elevated for some time, even though we do see inflation dropping. Because of all the things that are going on with supply chain disruption, things that are going on with wages, things that are going on with depleted inventories, and we've got this backlog of orders. All of that's creating some inflation. But I do like the chart that's on the right-hand side. The green line is showing what inflation expectations were back in December. And the blue line shows where they are today. So we do think that we're going to see some of this supply chain disruption improve over time, and we see some of that inflation going out. But I think the thing to note here is is that we are expecting that inflation to be elevated from maybe what our expectations were back in December. So what can we do with our asset allocation? How can we protect these portfolios from inflation? And that's the last chart in this group. Adding some of those inflation-sensitive assets to a portfolio makes a little bit of sense right now. And this ties into some of the other things that Brett was talking about, growth or value. So typically, those inflation protection or those assets that are resistant to inflation tend to be more of those value stocks, but more of those dividend-paying stocks. So ideas to add to your portfolio would be real assets like commodities, but also equities that are tied to commodities, energy stocks, very interesting right now. But I would also put some of the other value sectors like consumer staples in this category as well as good inflation protection. So that's a little bit, David, a wrap up of how we can take some of the themes that Tim and David and Brett and Deborah talked about and some asset allocation ideas for clients to visit with their advisors about.
Thank you, Chris. And we're right at 6 o'clock, so I want to be conscious of everybody's time, and I know that we've taken an hour out of your evening tonight. The last thing that we really wanted to touch on as a group was alpha opportunities that we see, and just to highlight a couple, I'll tick down this list a little bit quickly in the interest of time. Chris just talked about inflation protection. That's definitely an alpha opportunity that we see as an investment committee, and looking at things like energy and commodities, to really bolster your asset allocation and protect against inflation is something that we're talking about with clients. We highlighted the disparity between international and domestic, right? And the opportunities, you heard it not only from Brett, but also from Deb in fixed income. And, we heard it from Chris in asset allocation, right? So depending on where we are in the cycle, international presents opportunities from a valuation standpoint relative to where we are from a domestic standpoint. So that's something that we're going to continue to highlight and continue to monitor and make tactical shifts to our asset allocation as it's appropriate. Lastly, the last two things that we'll mention is, hedging portfolios and utilization of private capital, right? So as we just talked about, Chris highlighted, Brett's point of extreme growth, and that growth might not go away, but growth will slow down, right? And so, those present opportunities for, pullbacks and opportunities for us to hedge portfolio and hedge portfolios and manage risk. So that's something to talk to your team about and understand where you are from a risk standpoint. And our biggest job is balancing risk and return for our clients. And the last thing that we would talk about is private capital, right? So having access to, non-correlated assets that really don't, follow the cycle that we've just been focused on, right? So things that have, longer lockups and illiquidity and things that we can take advantage of if we don't necessarily need immediate, access to cash in a portfolio. Taking advantage of illiquidity premiums, and then having access to pre-IPO companies. Those are different, unique ways to look for alpha in portfolios. So what I would encourage everybody to do is take this information, process this information, and circle back with your team and making sure that I know this is something that we're constantly addressing with our clients, and it's something that we're constantly addressing as a committee as we make sure that we are, getting our best thinking to you, our clients. So with that, we are going to conclude our capital markets update call. And I thank everybody for joining us tonight. If we didn't get to one of your questions, I would encourage you to follow up with your team, and we will be happy to, address in person. Thank you, everybody, and have a good evening.